Alright, so the authors in this study are looking at the Vietnam stock exchanges in relation to different factors that have been studied in the past, for instance, value, momentum, size, and illiquidity factors. And so the first one is the value factor. They looked at the earnings yield to see if investing in companies with high earnings yield will earn excess returns compared to an equal weighted average of the overall stock market and also stocks with low earnings yield. And they did find that to be the case. So over here we have, this is the holding period. They looked at holding the stocks for 1 month to 36 months. We have the returns of the top portfolio. This would be the stocks in the top 15% of the population were related to earnings yield. This is the stocks in the bottom 15%, and this is the equal weighted index of the overall stock exchange, as if we were to invest in each of the stocks equal weights. And then we have a lot of different columns to show the differences between these. So we have the top minus the index, we have the bottom minus the index, and we have the top minus the bottom. So at first glance, we see that investing in the top portfolio in relation to the earnings yield gives us excess returns. Excuse me, we have positive returns by investing in this portfolio. We have negative returns if we invest in the bottom of the earnings yield portfolio. Equal weighted index is all over the place. But let's start here at the top minus the top minus the bottom. We see that we do have excess returns where the return of the top is higher than the return of the bottom. Pretty big number for monthly returns. But looking at the T statistic, it looks like these are only statistically significant at the 5% level once we get after the 9-month period. So we could say that if we were to use this strategy, most likely we would want to hold for more than 9 months to avoid the likelihood that this difference is actually just zero in the 1, 3, 6 month strategies. But what's really interesting to pay attention to when we drill down into the top minus the index and the bottom minus the index is that looking at the T statistics over here, it's actually the bottom minus the index that gives us most of the significance. Since these T statistics of the top minus the index aren't very significant, it's difficult to say that this difference is more than zero. So actually all of our return is likely coming from avoiding or shorting the bottom of the earnings per share ratio, so more growth related companies. So just by avoiding growth companies in the Vietnam exchanges might give us beneficial returns. And this chart kind of explains or shows in visual format the returns. So here we have the top minus the bottom. It's interesting to see that as the holding period goes on, the excess returns actually kind of decreases over time. And this is shown by the top minus the index getting closer and closer to the bottom minus the index. And really coming in from the bottom minus the index is getting more in line with the top. And next we have the momentum strategy where we would buy the top in relation to past returns and sell the bottom in related to past returns. And we see in this way, top portfolio is always positive in different holding periods, and the bottom was always negative in holding periods. Equal weighted index is really about zero. So coming over into the top minus the bottom, we can see the 1 month is statistically significant at the 5% level and the 24-month, but in between, it's not really statistically significant beyond the 10% level. So it might not be appropriate to say that this difference is more than zero, but there may be something here in the 1 month and 24-month periods. And so from the top minus the index and the bottom minus the index, we definitely do see some differences, but we don't have any significance in regard to the t statistics. So the authors do conclude here that momentum is an effective strategy, but maybe we should caution that it's not really appropriate over most of the time periods here. And we can see this here with this chart, and this kind of reflects prior studies as well in the US and across the world, whereas the holding period goes on, the reversion back to the mean gets closer and closer to where there's not really much of an excess return beyond a 12-month holding period. And here we have the liquidity strategy where we're buying the top 15% of liquid stocks and selling the bottom 15% according to liquidity. So we've got liquid stocks and illiquid stocks over the different time periods. And we see here that first, taking a look at the top minus the bottom, we do have a significant difference in returns, and these are significant at the 1% level. So we can almost have an unrefuted conclusion here that buying liquid stocks is better than buying illiquid stocks in Vietnam. And this might really make sense because the stock exchanges in Vietnam are new, and so liquidity is a very valuable part of a stock at this time as the exchanges get more mature. And coming down here to the chart, it looks like a lot of the excess return comes from buying the top 15% according to liquidity. The bottom doesn't really change much over time. So really we could say that maybe the bottom 15% are getting about the same amount of return over different holding periods. All right, finally we have the size strategy where it's buying the top 15% and so the largest 15% largest companies and selling the 15% smallest companies. So the first thing to note, the top minus the bottom, the t statistics aren't statistically significant, so we can immediately conclude that buying the top and selling the bottom size portfolios are not statistically different from zero. And in fact, these returns are reversed, where typically in a size strategy, the smaller companies should outperform the larger companies, but that's actually not the case here. What we have here is that the smallest companies are underperforming the index and they're underperforming the largest companies. So it's kind of backwards from what a normal size strategy should conclude on, and of course it's not statistically significant either, so it's difficult to rely on it. But what we do see is that the bottom minus the index is very statistically significant. So we might conclude that very small companies underperform the index by a lot, and this might be due to, again, the stocks in Vietnam or the exchange being very new, and so smaller companies are more likely to be risky or not very good investments, and therefore the larger companies should be more valuable to investors, at least until the exchange gets more mature.